Alright, so welcome guys to today's lecture. It is currently July 6th. It is a Sunday, and today we'll be covering these three topics: effective stop-loss placement, the Wick CE, and how to navigate effective news trading strategies. So I guess we'll just cover the Wick CE lesson first, because it's relatively quick and simple to understand. So why do we care about wicks, and especially their consequent encroachment? So what are they actually telling us? So the way we look at wicks is in the lens of trapped buyers or trapped sellers. So while this wick is forming, right, if anybody wants to go short, this candle would be like a large black candle in live time while it's forming, right? So anyone that's trading this candle, if they went short, well, as soon as the wick goes back up, if they entered like here, for example, if their entry was placed here before the candle closed, then now they're trapped as soon as the wick's back up, right? That's one way of looking at it. Another way is wicks are often manipulations that take out liquidity. So if you take a look, this is a sweep of the London range low sell side. Also, it swept the Asia range low sell side. So once you see these two sweep levels, this could frame our narrative to place a buy position. So why particularly do we care about this wick? Because this wick took out liquidity. We don't just look at every random wick. With the wicks need to have logic. And the logic of this particular wick is that it took out liquidity. It's a liquidity sweep, or a raid on stops, you can call it. And after this wick closes, or this candle closes like this and leaves behind this long wick, we are going to monitor the consequent encroachment level. Why? Well, if you think about it, wicks are a part. Yeah, I'll try to explain it another way. Okay, so if you guys see this, right? Up and then down, like right here. So this on a higher time frame is actually going to be forming a wick. So if we put a timer on, or the vertical line on 9:30, go on to 15-minute chart. Let me go to replay mode. So let me go on the 15-minute chart. Okay, so it's not a wick yet. Okay, so on the 30-minute chart, that price action up and down appears as a wick, correct? So if we go down to the 1-minute chart, that wick looks like this, right? Looks like up and then down. So this took 30 minutes to form on the 1-minute chart, but it appears as a single wick on the 30-minute chart, correct? Let me get rid of this. So why is this important? Because inside of a wick are invisible fair value gaps. No way, I just said that. Inside of a long wick, there are invisible fair value gaps which we cannot see on our current time frame that the wick is on. Feels like kindergarten. I'm just trying to add some emotion behind it. Okay, so if we go to the 5-minute, right? Look at the fair value gap that forms during that 30-minute window, or that 30-minute candle, which is not visible to us on the 30-minute chart. See, no fair value gap. But on the 5-minute, there's a fair value gap, right? And we have this inversion fair value gap on the 5-minute. All of this forms because of the wick on the 30-minute. But if we go down to the 1-minute, we can find more inefficiencies. Look at this. Imagine you took this trade. That's a top wick. That's a top tick kind of trade, right? Imagine taking an entry on this fair value gap and targeting all of this low resistance sell side and taking your trade all the way short to the London range low or the Asian range low. You guys think you could have caught something like this? Took a while to form, but you guys already know what happened. So let me speed it up a little bit. There we go. So let me go back. We're basically just covering wick CE so far. Wick CE, the wick consequent encroachment of long wicks. So let me go back to the 30-minute chart, right? So this 30-minute chart appears as a long wick, okay? Now I said that inside of these long wicks, which the particularly sweep liquidity, the particular wicks that sweep liquidity, or the wicks that are part of a manipulation leg. Let's say you're in a market maker buy model and we're looking to a reversal, right? This is your original consolidation of a market maker buy model. If you guys don't know what the heck I'm saying, I'll link a video to market maker models. But this is the original consolidation. This is the manipulation leg up, and this is what we call the smart money reversal, right? There will be a manipulation higher, leaving behind this wick. A wick is manipulation, guys. You guys know that, right? Every single wick is manipulation. On every time frame, a candle has a wick, a top wick, and a bottom wick, and the body tells the story. But these wicks are just the damage. You've heard ICT say that. Wicks are the damage, the bodies tell the story. So every single wick that you see is a manipulation in of itself in the context of open, high, low, close, or power of three. So these long wicks we view as manipulation legs, and we take our attention to the consequent encroachment, or we can zoom into the lower time frame and find invisible fair value gaps that is not visible on the 30-minute time frame, but are visible on the lower time frame. So this price action here, 930, 935, 940, 45, this time window here, up and down, that is a wick on the 30-minute, correct? Leaves behind a fair value gap. Okay, you can see the sensitivity there. And then if you guys know about the first presentation fair value gap, the first fair value gap that appears at 930, you can see that this is your first presentation fair value gap. Once we invert it there, we can look to put a short order and stop above the high and then target opposing liquidity, all of this low resistance liquidity. So in my last lecture I covered the fact that this is all accumulation. It looks like an expansion, but it's actually an accumulation. So you guys can check out my July 1st lecture where I covered how smart money views manipulation, accumulation, and or accumulation, manipulation, distribution. So check that lesson out for that. Basically, this is a false rally, and the actual smart money intention is to take price lower. So first they will engineer sell stops below this trendline liquidity, or we call it low resistance sell side, and below the session lows and highs, which is the London low and the Asia low. If you don't like this particular entry off the inversion, there is a fair value gap entry with all of this inefficient delivery. See the series of down close here? So you can merge all of these candles, 1, 2, 3, 4, 5. If there is multiple fair value gaps, as you can see, there's a fair value gap here, there's a fair value gap here, there's a fair value gap here. You can cycle through your charts until they become one fair value gap. So if I go on the 2-minute chart, I go on the 2-minute chart. Okay, so now we have this fair value gap, we have this fair value gap, but this one is gone now. So we can take a retrace entry into this one or this one. We can maybe go better, go on the 3-minute chart, see if there's still a fair value gap. So here it is. So here's the 3-minute fair value gap, and notice how it appears as one fair value gap, right? If you go on the 4-minute, there is still a fair value gap right here. And the 5-minute, there's this fair value gap. So if there are a lot of fair value gaps, go on the time frame, the highest time frame you can, where the fair value gap still exists. The highest time frame you can. Is it the 5-minute? Does it appear on the 15-minute? No, it doesn't. It appears on the 5-minute. That's the highest time frame. You can see the fair value gap, right? So that's why I choose this. You cycle through 5, 4, 3, 2, 1 until it becomes one fair value gap. But what's up? Yeah, and once you see the highest time frame fair value gap, that's the one you want to take. Because if you look at the 1-minute, you might get tripped up. Which retrace do I take? You know, while this candle is forming here, do I take the short off this fair value gap? Do I take it off that fair value gap? And then your stop loss has to end up being much larger than it should. So just go in the 5-minute and put your stop loss above this body right here, right? No, okay. Yo, this is Wick CE, not fair value gap. Yeah, we're covering Wick CE, but Wick CEs are pretty much just fair value gaps on the lower time frame. That's why they matter so much. If you look at the 1-minute chart, right? Maybe on the 5-second chart, these long wicks appear as fair value gaps on the 5-second chart, right? And you want to break up these long wicks, which took liquidity, into segments of quarters. So the 0.25 level, the 0.5 level, which is the CE, 0.75, and then the actual low. So you want to monitor the long wicks and the reaction to them. Now you can even look for what's it called, SMTs on these long wicks. So if the long wick is formed on ES, but not a long wick formed on NQ, that's also a sign of manipulation. So these kind of long wicks you want to be monitoring. You know, this one, manipulation, right? You can see the sensitivity there. If you had placed a short order there, targeting these lows, that would have been a successful trade. And your stop loss would just be at the high. So if you just use Wick CE, this is a successful trade right here, 3.5R. How would we enter a Wick CE? So personally, I want to see an entry off the 0.5 level. You can enter off the 0.25. Let's say that the drawn liquidity is really strong. It might not even come to the 0.5 level. It might just shoot up straight higher or straight lower because price is in a hurry to get somewhere. But an ideal scenario should come to the 0.5 level. So for example, if we go to the 30-minute chart here, let's go to the 1-hour chart even. Let's see. So this long wick here, we will monitor the levels. The 0.5, 0.75, the 0.25, these levels, which should be sensitive. But before that, you need to have a draw on liquidity. Remember, our draw on liquidity was the Asian range and London range low. And we have a, yeah, that's how I get top tick entries. What's up? Did someone have a question? I hear someone's mic constantly going in and out. If you have a question, just leave it in the chat. Let's go over some trades. Okay, yeah, one sec. Okay, I wanted to show you one example of Wick CE. So we're gonna watch for London range low because these are, remember, you need to look for wicks that sweep liquidity, right? Those are the highest probability wicks. So let's wait for this wick to form. on the 5 minute. Okay, so now since this wick swept liquidity, you'll be monitoring what? The CE, right? The consequent encroachment. Okay, that's the 5 minute. Let's go to the 1 minute. If you use entries off the lower time frames, you will get more precise entries. So right here, this is the 1 minute wick that took liquidity, and you can see the reaction off the consequent encroachment. So if you wanted to take a bottom tick trade on the idea of a reversal or a retracement back into the range here, you can see a lot of there's equal highs here. Oh, those are actually perfect equal highs. You can look at maybe this swing high, maybe these swing highs, whatever. You want to take a retracement trade. Maybe you see, let's go to the 5 minute. You see this range here, and you're anticipating a retracement back to the equilibrium point of this price range. So the equilibrium point of this price range is also aligned with this high. So your bias or your trade idea can just be a retracement trade long after these key session lows have been swept, to take a long to the 0.5 level or the equilibrium price point of this dealing range. Why does price? Because when price goes one directionally, right, there has to be a pullback at a certain point. Price doesn't just move down forever or move up forever, right? So it has to go up to fill some orders here before they can generate enough liquidity sell side to either continue going short, or they have an idea to take this longer because there's higher volume liquidity pools up here, right? So let's go back to the 1 minute chart and let's see how this trade would have played out. So once you see this wick, okay, this long wick, you're monitoring the next candle or the preceding candles. As soon as you get that tap, you can look for a buy, target the equilibrium price point, stop loss below the low. So stop loss below the wick low. Messed up. So you get that entry there. Now on real time, your entry would be even better than that, because it's replay mode. I can't enter as it goes down. The candle closes immediately. And this would be your trade. So let's just play it out. There we go. So pretty much you caught the low and you caught the high using this framework. Any questions about how I took this trade, why I took this trade? Does it really matter on time, or can we enter on any time? Yes, you do want to combine, like, what's it called, the key times, the kill zones, right? So notice where this swept liquidity, exactly 10 minutes after the New York PM session open, right? You don't want to be trading this maybe because it's not a part of your model, or because it's lunch, right? So 12 p.m. starts the lunch session, and then 1:30 starts the PM session. So look at how terrible the price is at lunch, and then the PM session, 10 minutes after the PM session, which is at 1:30, we see a sweep of liquidity. So now you're combining the kill zones, the New York PM kill zone, and price. You're combining time and price. You're not trading random ass candles at random ass times. I hope that answered your question. I do want to go over a trade I took. Okay, so this trade here. So like, how did I know this was gonna happen, right? Why did I take this particular trade? This was the trade that we took together in the Discord um, on Wednesday, July 2nd. So I don't know if you guys remember this day, but we traded this together, and I posted the signals in the Discord. And if you guys take a look at the video here, lecture recordings. So this little clip that I posted. So this clip was made on Tuesday after the Tuesday session close, or Tuesday daily candle close. Okay, so that was the bias that I made on the Tuesday. So at the current price, what we saw was this. So that's the current chart I'm looking at in this video. This is what I was currently seeing. So what the heck's going on? My trading view is bugging out. Can you guys still hear me okay? Okay. So let me go back. 5 minutes short. So yeah, this is a Tuesday. I was looking at this, right? And I kind of gave you guys a bias. I said I wanted to see these lows get traded to, but we did have this daily level for value gap here. And so what I said, so if you guys pay attention to what I said, how did I come to that bias? Okay, so well, we had a massive sell-off, and if you're familiar with the weekly profiles, the Monday candle created the high of this week so far, right? And if I am bullish, we are extremely bullish. If you can just look at the price, pretty obvious that we're bullish in the higher time frames. We want to see either Tuesday or Wednesday create the low of the week in terms of the weekly profile. So we have Monday accumulation. So if you take a look at the weekly candle, if you just imagine the weekly candle, okay, we have a small range Monday. Okay, what are we seeing on Tuesday? We're basically seeing the bottom wick of the weekly candle unfold. So I know you guys had a lecture with Para on Power of 3 in the open, high, low, close. So you guys should be familiar with this concept now. So if we expand this or extrapolate this to the weekly candlestick, we have Monday, which is a small range accumulation, right? So the weekly candle looks very small at this point. Then we see Tuesday trade lower. So there could only be two profiles that could play out. There could either be Tuesday low of week and then expansion higher, or Wednesday low of week and then expansion higher. Manipulation rate. So this is creating the bottom wick of the weekly candlestick. Yeah. So now if you take a look at Wednesday, so let's go to Wednesday. So that's the Asia session for Wednesday. This is the London session for Wednesday. So now we can go down to the 5 minute. Take a look at what I was actually looking for. So here we have classic, it's going to make what I was anticipating as a rate of Asia low. And we have these lows here that I want to see rated. And specifically in the video, you guys can take a look at what I say. So this was said on the Tuesday. Right here. Okay, you guys heard that? If 8 o'clock to 8:30 trades lower, right? Trades lower, then it means the open 9:30 will be bullish. Okay, if 8:30 trades higher, that makes me bearish because then we're trading the manipulation leg. So 8:30 would have created the manipulation higher for then 9:30 to distribute lower. So that was the framework that I had. So if you can go to the today's price action, the Wednesday price action, and I marked out the 8:30 candle right here, the 8:30 opening, and we saw precisely that happening at 8:30, 8 o'clock, 8 o'clock right here. This is 8 o'clock. 8 o'clock to 8:30, we saw price trading lower, okay, which took out this low. Now what am I looking for? For the 1 minute chart, I'm looking for any sort of entry method. Doesn't matter what entry method. You can look for an inversion fair value gap. You can look for an OTE. You can look for a wick CE. Doesn't matter. Whatever presents itself, I will look for. Order block, mitigation block, volume imbalance, breaker block, whatever. The PD array you enter off of doesn't matter as long as you have the direction correct. So this is the trade I took here. I waited for the 9 a.m. open. So at 8:50, right, 8:50 starts the macro time for the 9 a.m. candle. So the 8:50 hourly macro. It lasts up until 8:50 to 9:10. So I was waiting personally. I know Para entered somewhere here. Just when he saw this inversion here, maybe he just entered off that. I was waiting for more confirmation because the 9 a.m. candle could easily wick me out, and I didn't have a logical stop. This low could have been my stop, but I wanted to see more confirmation. So let's take a look at the 9 a.m. open. So here's the 9 a.m. open right here, this one. So 9 a.m. open, very small range, and I'm marking it. Okay, I'm marking it. So there's 9 a.m. open right there, right? That low. So let's take a look at what happens. Okay, so this candle that happened at 9:01 did not form like this, obviously. During its delivery, it was a massive black candle that had traded all the way down. So my entry was just off of this fair value gap and retrace into this. So this fair value gap never got disrespected either. And also we have an order block here which it traded into. Okay, now let's take a look at the following candles. Okay, now look at this candle here. This candle hits the 9 a.m. opening price to the tick. Okay, right here. That's where I want you to take your attention. There's the opening price. The candle trades down, hits the 9 a.m. open to the tick. Note that. It's not random. Okay, so now this long wick we could have considered as well, but because I saw that, I did not consider this wick anymore. Let's take a look at this wick. Maybe I don't think it traded. No, I did not trade the consequent encroachment. Right, so sometimes when price is too bullish, the consequent encroachment doesn't get traded to. So that's just not an entry technique I would use at that point. Hold on. Looks like you guys have a question. Yeah. That's why I use the 9 a.m. open. I use every single hour's open, actually, because I use power of 3 to frame my trades. I want to see accumulation, manipulation, distribution. So if the 9 a.m. opens like this, and we had basically the tiniest wick down, there's no manipulation, this is the manipulation, and now we want to see expansion or distribution, right? So let's take a look what happened. Right, and that was today's trade. What was my target? It was London range high. It's very obvious targets there. London range high has equal highs with this high, this high, this high. You know, this triple top here, that's like a very strong liquidity level. Like if you take a look at this, it's equal highs stacked with more equal highs. It's just pretty obvious what's going to happen there at that point. So if you guys are confused about what's it called? If you guys are confused about the draw on liquidity, I can't find the draw on liquidity. How do I know where price is going to go? Study the weekly profiles, study the daily profiles, and study what was I going to say? Just study the sessions, right? So what happens with the sessions? So this time-based liquidity are the strongest form of liquidity. Sure, equal highs are strong, but why not time-based equal highs? London session range equal highs. And using that narrative, you can frame the draw. You can kind of know where price wants to go to, and then the entry model is up to you. You could have entered so many different ways here, right? So this inversion fair value gap, I know Para took a trade somewhere down here. I don't know exactly what his entry model was. I think it was just turtle soup. I think after he saw this sweep of this low right here, he just straight up went in right here, right? You could have entered here on this fair value gap, right? Here is the change in state of delivery. 1, 2, 3, 4. These candles here, consecutive candles. You could have looked at that, right? And we hit the the change of state of delivery, which is paired with the 9 a.m. open. You could have went in there. What else? This fair value gap. Once this gets inverted, right there, you could have put a limit order at the high. This candle would have triggered you in. If you miss that entry, fuck it, right? This is a fair value gap right here. Enter there. If you miss that entry, there is a change of state of delivery. Look at the precision there, how it hits the change of state of delivery there. These are the series of down close candles that took liquidity. That level is the change of state of delivery. What about the CE of that candle wick? The first candle that formed the bullish FVG after the manipulation. The first candle that formed after the bullish. This one? Order blocks got tapped all the way along. Yeah, exactly. So this was beautiful delivery. All these order blocks, look at these order blocks here, right? Order block went down, tapped it. Order block went down, tapped it. Order block went down, tapped it. Right? So the wick CEs can be used after a liquidity sweep. It can also be used after what? After a tap into a PD array, like an order block. So if you want, you can also use the long wicks that tap into an order block for an entry. Let me just get rid of this green box because it's annoying. But if you take a look at this, this wick here tapped into this order block, and you could have waited for the retrace to the tap of the contour encroachment of this wick right there. Right? For a more precise entry, you could have took that one, or when it came down to the contour encroachment, you could have added to your position. Up to you. Can't we turn Wixie into a rejection block for more probable trades? Which is liquidity sweep and PD rate tap. Yeah, you could say it's a rejection block, but personally, rejection blocks occur for me at external levels, right? So this level is external. So this would be your rejection block, which in this case did not get tapped into. So if you study rejection blocks, you know that the higher probability ones occur at the external range of the range, right? Like internal range rejection blocks, not really something I look at. Third candle. The third bullish candle after the manipulation. So which manipulation are you talking about? Okay. Yeah, I don't know what you're talking about, Scar. Like like this manipulation. Third bullish candle, this one here, this large one. Oh, you're referring to this wick CE? That one there? And yeah, that's a beautiful level here. Tapped it perfectly. And you see this black dotted line. It's a previous low that the market referred to again. So this low, the market referred to again, tapped into it here. So that's also algorithmic precision. Yep, I can hear. Are you talking about this order block right here? Oh, this candle. Well, the CE of this bottom wick? Personally, I wouldn't consider that because it's not a very long wick and it didn't take anything. It didn't take liquidity or anything, right? I'll be looking at this order block where this changes to delivery right here. So you can see it tab there. So to the tick right there. You see how many entry models there were, right? Like there's an order block entry here. There's this fair value gap entry. There's this inversion fair value gap entry. There's this change of state of delivery entry. There's this order block entry. There's so many entry models. The entry models doesn't matter. You choose whatever you like, whatever you see, whatever your eyes gravitate towards. What matters is the draw, right? Is price... When it comes to a fair value gap formed with an order block, then I will use the wick, right? It's situational, really. It's situational. So if you take a look at this, I use the wick here. I use the wick right here because it is paired with a fair value gap. So if you have a fair value gap and an order block being paired, you have to consider the consequent encroachment of the fair value gap, right? As well as the order block opening price, but I don't use the opening price when it's paired with a fair value gap. ICT does mention this in his lectures. I don't know exactly what episode, but that's how he refers to the order block wick versus the order block opening price. Because if you look at ICT's videos, he sometimes uses the wick, he sometimes uses the body. And he explained in one of his videos, I don't remember which one, but if there is a fair value gap and a order block, he refers to the wick because you have to also consider the fair value gap consequent encroachment. Does that make sense? Okay. Okay. So yeah, if you guys if you guys missed this entire entry, all of this, right? There was more entries, right? There was more entries, and there's this massive fair value gap, and then you have this order block, right? There we go. We tap into it there, right? You could have entered there. You could have entered on this fair value gap. As long as the draw on liquidity is not hit, you could have looked for an entry. Yeah, you could say premium, whatever, right? But if you take a look at the overall range, this range here and this range here, we're still in discount of the external range. But if you look at this range here and this range here, this internal range leg of this larger move, yes, we are in premium. So maybe for your model, you don't want to enter like that. You wouldn't want to enter here, but it's up to your risk profile. You could have entered here on the retrace of this fair value gap, but then really put a really tight stop at the low of this candle, right? And then if your risk to reward makes sense, go for it, right? Premium discount doesn't really have a big role as long as your risk to reward ratio still makes sense. If you're way up into premium and then your stop loss has to be massive and it's not even a logical stop, then yeah, that's different. Like, I would not be putting my stop like down here, obviously, right? Because my risk to reward is horrible. I would be willing to take this lower probability trade because we are in premium, and compensate for that lower probability trade by taking less risk on it, putting less contracts. Like if I was way down here, I'd be putting more size onto my trades because my stop can be smaller because my stop has to go at this low. It has to be a logical stop. You know, this gets into our first point, a logical stop placement. You don't put stops randomly, and you don't put stops based on risk to reward alone. Okay, you don't just say, oh, I need 2R minimum, and okay, my target is this, but for my target to be that, you know, like let's say, I don't know, let's say your trade is looking like this, right? And you're targeting 2R. Okay, well, for my target there, my stop needs to be here. That's how I can get 2R. Not really the best way to place stop losses. Your stop losses have to have logic behind them. You need to put them at logical levels, below an order block, you know, below this order block, below a large expansion, which you anticipate to be a breakaway gap or a tap into the consequent encroachment and run higher. So this fair value gap here would be a good spot, you know, to put the stop loss at the opening price of this large candle. This is where smart money placed large orders, right? Large orders. So why the heck would they bring it down to the opening price again? There's no point. Before the drawn liquidity, which is London range high, is hit, you know, they want to drive price higher. Here they drove it higher. They forced buy positions in the marketplace. This is actually the point where they started the buy, the opening price. So why would they take it all the way back down to where they bought it again, you know, after they already bought here? That's just, it's nonsensical. Breakaway gap. Also, can you read the logical? Yeah. So logical. This lecture is being recorded, by the way, but logical stops means key levels after a liquidity sweep. You know, liquidity sweep of a major low. A logical stop would be down here. Right? If you're taking this trade long, let's say you entered on a fair value gap retrace, my stop isn't just going here because I want 2R or want 9R. My stop is going down here because that's a logical stop level. Focusing on RR alone is a scam. It's a myth. Okay, don't only focus on RR when it comes to stop placement. You know, something that I hate seeing is when traders are like, oh, this trade is too risky. Let me have a tight stop. You know, I'm gonna have a tight stop, and then what's gonna happen is that's gonna develop paper cut losses. Because let's say you're going in here, right? Let's say you're going in here. Okay, I stopped that. Okay, so let's say you're going in on this fair value gap retrace, or rather it was this one. So here you're waiting for a fair value gap to form. Okay, and then you get one, and then okay, I'm gonna put my entry when we retrace into it. But then where does my stop go? Okay, well let's say you know, I'm targeting these highs. Okay, but I want 2R. Look, this is less than 2R. That doesn't follow my method, right? Okay, now I'm going to move my stop. Oh, okay, so I'm going to put my stop there. I'm going to put my stop there because I want 3R, right? And yeah, that just doesn't make any sense, right? Because what's going to happen is you're going to get a loss. You're going to take a loss, and you're going to keep taking losses, and you can develop over trading habits. So what's going to happen here is you're going to get stopped out, okay? You're going to get stopped out, and then you're going to look for re-entry, okay? You're going to look for enter again. Let's say off this inversion. Okay, well if you do re-enter, okay, what happens when you get stopped out again and again and again? Why not avoid getting stopped out again and again and again, and just put your stop loss at logical levels, right? Some people argue that it doesn't matter if you get stopped out 10 times because with the risk to reward model, if I have very tight stop losses, I can make back all my losses in one trade. And that is going to depend on your own model. Some people it works, you know. Some people it doesn't work because they can't handle it psychologically. Because if they take 5 losses in a row with really tight stop losses, maybe that's going to create fear because they're going to see the losses racking up, racking up the red P&L, and then that's going to create fear, and then they'll not take the trade after, or they'll lose so much that they're going to get closer to their maximum drawdown because they took 5 paper cut losses that seem small, but they add up, especially with the fees. And by the time you actually hit your target, you would have cut your profit margin in half or worse. You were correct about the direction. You were correct. Everything was correct, but your stop was too tight because you didn't want to risk much, or you didn't want to risk a certain amount. If you don't want to risk too much, just take less contracts. Just your stop should go where the stop needs to be. The stop needs to be where the stop needs to be. You don't move the stop based on your risk to reward. You can reduce your contract size. You can take less lots. If you're a CFD trader, you take less lots. That's all. Your stop needs to be where it needs to be. Take less contract size. Any questions so far? Okay, if there's no questions, I will show you another entry that you could have caught. So this is obviously the 10 a.m. silver bullet model. Are we still going on over news and how we can gamble that correctly? Yeah, we can go over it. Okay, so 10 a.m. open. You wait for the first fair value gap to occur after 10 a.m. There is the fair value gap, and you just put a limit here. You put a stop loss at the low, and then you target the London range high. So you put this limit order in, put your stop loss, put your target, walk away from the chart. Okay, you got triggered in there. Okay, you can look at the precision there. So we have a order block paired with a fair value gap. So I'm using the wick here, and we tap into the order block there. Look at the precision. This is called the silver bullet fair value gap, and then you can see the beautiful delivery to target. The tick of the order, yeah. With order block entries, they're very precise. With fair value gaps, they don't have to be as precise because there's a range, right? But with order blocks, there's a specific price level that the algorithm refers to, not a range like a fair value gap. Bro's gonna take 20 trades. Yeah, I'm just giving you potential entries that you could have taken. If you missed the original one, because there's so many entry methods. The main thing is to draw on liquidity. Okay, so let's go to CPI, and I'll show you how I traded that. So CPI, it was June 11th, I believe. Yeah, here it is. Where else can you get this banger sauce? This is exclusive content right here. Okay. Okay, so how did I take this CPI trade? Well, I'm looking at the daily profiles, and I see that Asian range low got manipulated, and we are starting expansion higher. 8 o'clock has this massive double-sided manipulation, which takes out both sides of the range, takes out Asian range high, but leaves this high still. And actually, this trade began on the daily chart. So let me go ahead and go to the daily chart. So let me get rid of all this. The reason why I was looking to take this long, if you go to this day, to Tuesday, so before Wednesday candle had printed. Okay, there. So that's the Wednesday candle. Okay, here's a Tuesday candle. So before Wednesday candle was printed, I'm looking at this fair value gap here, this daily level. It's called the SIBI, sell side imbalance, buy side inefficiency. So I'm looking at that fair value gap, and I want to see CPI inject volatility to then push price up into this internal level liquidity here, so internal range liquidity. So fair value gaps are internal range liquidity. So I want to see price go up and tap that. So that was my narrative. We also saw that the day before, the Monday candle tapped this daily level order block, so I just wanted to see a continuation trade up. So I'm bullish. So if we go to the 5-minute chart, let me play out this overnight price action. So this is Asia printing. Right, and then we saw manipulation of Asia, and then London starts to already expand up. And then 8 a.m. candle, oh, kind of revealed it. 8 a.m. candle here manipulates both sides. Okay, so I was just watching that. I'm not a part of any of this yet. We did dig into this balanced price range. So here's the balanced price range we dug into. So news, you want to look, because news is aggressive, right? So news is like CPI is really aggressive. So it'll have that injection of volatility to push price up to a certain level. The higher time frame has the highest liquidity, highest volume liquidity resting there, right? Because banks don't trade on a 1-minute chart. Banks trade on higher time frames. They have large orders that they have to hedge in, using these smaller time frames. But large orders sit on the weekly, the monthly, the time, and the daily level chart. So really, you want to do a top-down analysis where you start on the daily, and you develop some sort of directional bias. Is it going up or is it going down? Where is price coming from? Where is it going to? Okay, so here I was on the 1-minute chart watching this. And what am I watching? Okay, so I'm watching this long ass wick. Okay, what is this? Consequent encroachment. I'm watching that. If it does tap into that, great. And I'm waiting for 8:30. This is the CPI news data release. Okay, so let's keep watching. I'm looking at this candle wick too, because this is an order block, right? This is an order block, and I'm looking at the wick here. So the order block wicks. It's not a high probability order block, but it's still an order block, and it's paired with this small little fair value gap there, but I wasn't looking at that at all. Okay, so there, right here, we tap into the CE of this again. Okay, so now look at this candle here. So the consequent encroachment, like I said, can be framed as invisible fair value gaps on the lower time frame, correct? So if we tap into it, it's like the same thing as tapping into a fair value gap, the consequent encroachment of a fair value gap, correct? Now, what happens when we disrespect the wick CE? That's kind of like disrespecting a fair value gap, which is kind of like creating an inversion fair value gap, isn't it? So if you take a look at this, right? This long wick, we close over it. What is this now? It's like an inversion fair value gap, okay? On the lower time frame, on like the 1-second chart, the 5-second chart, 15-second chart, 30-second chart, whatever. I don't check the second time frames, but I can already know that there exists a fair value gap on the lower time frame than the 1 minute inside of this range. When we do invert it, now I'm looking at this. Okay, now also we have this fair value gap that's formed here. So we tap into that. Let's see, did we tap into the consequent of this? Just fell shy of this long wick here. we respected this fair value gap. Then we start to climb higher, and then we know what happens. So I had a limit order set here. So I had my first limit set here. So these are sell orders. So like that, I had a limit order there. I had a limit order here. And I had a limit order at the consequent encroachment. So these were my 3 limits when I was taking this trade. So they all got demolished immediately. So unfortunately, I couldn't get all the profits of this because this candle printed so fast. And then my limits down here got executed. So my largest limit was actually here. My second largest was here. And my last largest limit was here. You could have one shot, one killed it, but I had limits just in case it wicked. Right, so that was that trade. And you guys can find this trade on my Instagram or TikTok. Just look through the dates. July 11th, I took this trade. If you guys don't believe me. For these, for these, I didn't even have a stop loss. Because even if you have a stop loss in these kind of scenarios, they don't get respected, right? If you put a stop loss in this kind of scenario, they're not going to get respected anyways. So there's no point. So news trading like this is good on smaller evaluation accounts, or like whatever evaluation account which you don't care about losing. So just take it, or like a small funded account, like a 25k funded, where you can just afford to full port that shit. If you blow it, you don't care. If you win it, then you get a huge payout. The risk to reward is like insane. You just have to make sure your prop firm allows news trading. So I know Apex does allow news trading. That's the one I use. Did you do that? Oh, sorry. Did you do that trade on a real account? And I risked 40 contracts on a 25k account. So that's a full port on an Apex funded. Or four minis. Is he? Yeah, and I passed it. Well, I made $10,000 on this trade, but it was. I didn't actually make 10,000 because, like I said, my open PNL was 10,000. However, I had these limits, right? So my orders got triggered here, here, and here. So I ended up making about 5,000, half of it. If I hadn't had those limits, then I would have made the full 10 grand. But unfortunately, that's hindsight 2020. I didn't really expect this candle to be this large. How can you pass Apex in one trade or two? Yeah, there's no consistency. You can just straight up full port and pass it. That's what I like about Apex. You can just full port that shit and pass it. So you get you obviously get less when you take partials because you're taking off here, here, and here. If you held for the full thing, you get the 10 grand. But since I took off at these levels, technically my RR is less because of that. Want to find payroll? Okay. Okay, so June's non-farm payroll was here. So I traded this too, by the way. I predicted this as well. Again, if you guys want proof, my Instagram's there, my TikTok's there. I took this trade, so don't think I'm just hindsight cherry picking this. I know, but a lot of people just like talk shit and they're like, "Oh, you didn't take that trade. You're just a replay guru. You're just showing it in replay." And I'm like, "Okay, bro, whatever." Okay, so here, what we saw was, what's going on? Someone's talking. So I'm just gonna mute you. Yeah, so right here we saw, Asia range expand, or Asia range accumulation. We saw expansion after. We saw a little bit of a London range expansion here, and then a retrace into this inefficient price delivery here. And then here was really what I was looking at. So this was pretty obvious to me that, seeing this massive displacement down, and then the next candle displaced up, right? So at this level, I was looking, okay, this is the manipulation. A lot of people got trapped here. This massive down close candle would have triggered a lot of people to go short, right? Either on the close or while the candle's forming. So people got trapped immediately on the next candle. If they had their stop there, they're instantly negative, right? Their P&L is instantly negative, and now they're hoping and praying it goes back down, which smart money is not going to do. It's not going to go back down after doing this. They sold and they bought. So this is a good level to put your stop, maybe here or here. Also, there was SMT. If you look at ES, so this low took out this low, right? This impulse moved down, took out this low, so SMT. So that's number one. Usually SMT is set in first when it comes to these kind of things. You will see the SMT first. So we see SMT, take a look at NQ. It failed to take this low. That's already a big, signal saying, okay, buy. This is a long. Do not look for shorts here. So then we have a huge chop around, fucking around. So what is this actually doing? It's accumulating orders, right? There's indecision before the news release at 8:30. So people are having different ideas. People are going, oh, I'm going to go short, I'm going to go long, I'm going to go short, right? Because they don't know what they're doing, but they're trying to gamble the news. But I know what's going to happen because I have the smart money lens. So then we see some, equal lows here. We see some equal lows. And we see a raid of the equal lows right here. So if you want, you could just go in there on a turtle soup. But personally, I need to wait and see for more confirmation. Okay, we can take a look at this candle here. If we get a close above this, that could be something I was looking for. We also tap into the consequent encroachment of this wick, which took liquidity. Also, one more thing. What I was actually looking at here is, remember how if we have price going up, then down really fast on the 1 minute chart, okay? If you go to the 5 minute chart, this should look like a wick, okay? It should look like a wick. So let's go to the 5 minute chart. And look at it, it's a wick, okay? This here at 725, okay? This here at 725, okay? This at 728, it would have taken the 5 minutes to form, and then 7:30 would be the candle close. But this is a wick on the 5 minute chart. See that? So now take your consequent encroachment of this wick, okay? Lay it out, draw your quarters. Then the best position would be there, okay? The best order would be there. However, NFP might come into the consequent encroachment, but I wouldn't get filled because the price is too fast. So I'm trying to get in before. I could have entered on this quarter, or I could have looked at the preceding wick. I could have entered here. I think that's actually where I did enter, on the tap here of this wick right here. So this wick, I entered right there. But the best entry would be on this long wick right here. But there's only 2 minutes till CPI. You didn't look at higher time frame. Well, I did look at higher time frame. I just didn't mention it. But here we have this high right here. We have this high as our obvious draw on liquidity. We have these highs, failure swings, right? And all of these highs could be a level to scale. So personally, what I was looking at is this range to this range. I was looking at the consequent encroachment, so like there, but we were very close to it already. And I'm looking at this high, and this high. Very obvious. It's not really like the rocket science. I'm not like inventing new levels that nobody else sees on the chart. It's just obvious highs and lows that I'm targeting. Why is the 0.5 so crucial? What makes it? It's like equilibrium, right? Equilibrium price points are important because it goes into smart money mitigation. I can go over that. I can add it to the list, smart money mitigation. mic is on a bub. What happened? Okay. Alright, so let's take a look at what happens. Go back to the 1 minute. So I'm looking at the close over this down close candle that will form the order block. Manual, okay. Alright, so there we go. We get that close, right? We do also get a volume imbalance right here. So maybe we can take a trade into the retrace of that. Or we could just take an entry right here. And your stop below this low. Personally, I didn't have a stop. But if my stop was to be put in, I would put it below this low. I'll put it there. But again, NFP, your stop doesn't get respected anyways. So this is my target here. And then this is my other target. So let's go to the 5 minute, check it out. Let's go to the 1 minute, fuck it. Okay, let's see if we get to tap into that volume imbalance. We did not. Okay. Remember, pay attention to this 0.5 level. Okay, this 0.5 level. That's the 5 minute CE. Take a look what happens. Okay, so it just goes higher. Okay, so I guess my target wasn't that. Oh, it was this high. Yeah, it was these equal highs here. That was my target. Yeah, so those highs are pretty equal. So that was my take profit right here. So that was my NFP trade. Any questions? Yeah, I just went for the first obvious equal highs. And we had these highs as well. So those two highs were my target. No, CPI is usually more volatile. NFP, it depends on like the news. CPI is usually way more volatile. You could take a look at what CPI, the range of CPI candle is much bigger. NFP can be large if there is like something that happened in the job markets which created much less jobs or much more jobs. Because that's what non-farm payroll is. It's the creation of new jobs in the US labor market since last month. But what is consumer price index? That's literally the so basically look from a page. Yeah. So what is consumer price index or CPI? It's literally a measure of inflation month to month. So inflation is a huge figure. It's a huge level. It's a huge news, economic driver of price. It's probably more influential than jobs, because CPI, your inflation impacts everything. It impacts your grocery prices. It impacts the housing market. It impacts literally everything you can purchase. Inflation impacts. So that's why CPI is such a huge measurement and driver of volatility. Any more questions? That's NGAS background. What are other news? So yeah, the three highest news impact drivers are NFP. So in order of magnitude, it's CPI, NFP, and FOMC, but specifically the press conference. Oh, I didn't hear Manuel. I'm sorry, Manuel. Were you talking? Yeah, I muted because there was sounds on his microphone. Okay, so yeah, if you have a question, put it in the chat. I'm just gonna mute the mics. All that sauce for free, yeah. You guys got all that sauce for free. Wait, did you only mute my sound? Yeah, I muted your soundboard. Okay, so if there are no more questions or further questions come up in the future, just put it in the questions tab. And I'm going to be ending today's lecture here. So it's about an hour and 10 minutes in recording. I'll be posting it very shortly, as soon as I can get it uploaded onto YouTube. Alright, so thank you so much everyone for joining the lecture. I hope it was very insightful for you and you got some value out of it. And I'll see you guys in the next one.